Thank you for joining us. We will be starting at 11 o'clock Central Time sharp. Thank you for joining us today. We will start in 2 minutes. Welcome to all joining today's presentation of the Charitable Gift Annuity and Effects of the Tax Cuts and Jobs Act of 2017. We truly appreciate your taking time out of your busy fundraising schedules to learn more about the Charitable Gift Annuity and gain insight as to how the Tax Cuts and Jobs Act of 2017 affects CGAs and charitable giving. I'm Elaine Appleby with the Charitable Giving Resource Center, headquartered in West Des Moines, Iowa. I've had the pleasure to partner with many of you in setting up CGAs, CRTs, CLTs, and pooled income funds to benefit your nonprofits and your donors. At CGRC, we live in two tracks, one being the gift planning education space for donors and nonprofits, and the other one being plan gift implementation such as CGAs. This presentation will combine both of those areas as we share with you information regarding the CGA as a plan giving tool and how you can offer them to benefit your donors, their families, and your organization. John will also discuss how the new tax law provides opportunities in the annual and plan giving space, as well as talking points for nonprofits to provide positive messaging to their supporters. Just a note, as of November 1st, we can now offer CGAs in all of the United States, excluding Hawaii. Now, if you have a question during the presentation, please type it in the question box. We will answer as many as we can at the end of the presentation. At this time, I'd like to introduce John Severson, Strategic Advisor for the Charitable Giving Resource Center. John is an expert in the field of plan giving. He speaks nationally on the topic and is a contributing author to the newly released Unprepared Heirs at Risk, 14 Elements of Successful Wealth Transfer. Through working with donors, John quickly realized that not all nonprofits had the ability to offer CGAs, CRTs, and PIFs, a challenge that John set out to resolve, as he says, to level the playing field. Through his diligence in assembling the best of the best in partners, John has created the solutions. John, thank you, and I will turn the program over to you.
Well, thank you, Elaine, and welcome, everyone. It's a pleasure to be with you today on this, one of my favorite topics, and that is charitable gift annuities. And so here's our agenda for today. We're going to, for those of you that might not be real familiar with charitable gift annuities, might not be currently offering them, we're going to kind of give you the basic rundown of how they're constructed, how they work. And then we're going to talk more about actually implementing charitable gift annuities, kind of the mechanics. And then today, because of the new Tax Act, we're going to then be helping you understand what impact the new Tax Cuts and Job Acts of 2017 has had on charitable gift annuities specifically. This is not a tax seminar. There are plenty of those going on. We attended a great one yesterday put on by the Stelter companies here in Des Moines. So we're only going to be focusing on today how the Tax Act affects specifically charitable gift annuities. So with that, and again, if you want to put in your questions into the question box, we'll leave time at the end for answering those questions you may have. But I have a question for you. Would your donors choose to allow Congress to direct their philanthropy through taxation? We call those involuntary philanthropists. Or would you rather have them choose to benefit themselves, their family, and their favorite causes through a planned gift? And I think we know what the answer would be. It's just so amazing to me that many donors don't know that they have a choice. So we're on this quest to educate the public on the benefits and of planned giving for themselves, their family, and their favorite causes. So, you know, how many of your donors currently receive a check from nonprofits they support? When we ask donors, they say, well, I don't get many checks. I send a lot of checks, but many of them would like to start receiving a check, and that's what split interest type planned gifts are all about. So the planned giving vehicle that we're going to be discussing specifically today would be the charitable gift annuity, actually the oldest split interest gift, been around since the late 1800s. Long time, truly tested. So for those of you that aren't familiar, what is a charitable gift annuity? It's actually just a contract, only usually 2 or 3 pages long, that guarantees annual payments for the life of the donor in exchange for a gift currently of specific assets to the nonprofit. At the passing of the donor, 100% of the remainder is going to go to the nonprofit that they select. And the payments to the donor can be either starting right now, immediately, or sometimes it makes sense for them to defer their payments for 1 or more years and have those payments commence a little later. Either way, the donor gets an immediate charitable tax deduction. And we're going to hit on that a little later as far as what how the impact of the new Tax Act has had on those immediate charitable income tax deductions. I think you're going to be pleasantly surprised. And as I said, the CGAs have existed for more than 160 years in the U.S., so they're not the new kid on the block, yet there are many, many nonprofits that are not equipped and probably should not be issuing charitable gift annuities, and we believe we have a solution for those in that camp. So let's see, I'm a visual learner, so I've got to see a picture of this. So when we set up a charitable gift annuity, we see on the screen there to the right is a bucket, and it has a spigot on it and an umbrella on it. And the spigot provides income for back to the donor after they put some cash or appreciated assets into the gift annuity on the books of the nonprofit. But because it's on the books of the nonprofit, we're in a tax-exempt environment. That's the umbrella. That's a tax-sheltered umbrella. Did you know that's a tax-sheltered umbrella? Yes, it is. Well, then in exchange for that contribution currently of those assets to a gift annuity contract with a nonprofit, the donor receives an income for their life that they cannot outlive. And I've been in the financial advisory world for about 45 years. And it's interesting to me. It seems that the older people get, they're more and more concerned about, am I going to outlive my money? And that's true if they're worth $100,000, $1 million, $10 million, or more. It doesn't seem to make any difference. So then at the death of the donors, then 100% of what's ever in the gift annuity transfers to the charity. And in fact, it really would normally stay at the charity if the charity itself is issuing the gift annuities. We don't have to fight with the heirs. It's an irrevocable gift. And so the benefits to the donor, of course, they receive a life income, and I've underlined the word fixed. Many older adults are a little nervous about, stock market prices, real estate prices. They want to make certain that they're going to have X number of dollars in their mailbox every 3 months when they go to pick up their check. Well, a gift annuity by its design is a fixed lifetime income. The dollar amount that they initiate with the gift annuity does not change for their entire lifetime. Tax benefits are that, of course, there's a charitable income tax deduction issued at the time of the gift based on the value of the gift, the donor's age or life expectancy, and then the government issued Section 7520 rate, which changes on a monthly basis. And depending on what month the gift is initiated, the gift annuity is initiated, those three factors will indicate how much the deduction will be, and we'll give you some examples of that shortly. Then at the donor's passing, 100% of the balance is paid to the charity outside of the donor's taxable estate. It's outside of the will, it's outside of the revocable trust. There's no question that it is going to land on the doorstep of the charity, actually unlike a charitable bequest in a person's will. Charitable bequest in a will can be changed right up until the moment of death. That is not true for a gift annuity. Generally, we'll show you that there's about 50% of the original gift should be left for the charity if the donor passes away right on time at their life expectancy. If they pass away later, there may be less than half. If they pass away sooner, there could be more than half of the original gift left for the charity. So why would a donor even consider a gift annuity? Well, some donors have heard about charitable remainder trusts. They read about them and they say, that's a little more complexity than I'm looking for. And in our world, we find that gift annuitants normally are those folks that are wanting to set aside maybe up to about $250,000 or less. If you get much beyond that, then we start talking about charitable remainder trusts, maybe pooled income funds, something with a little more flexibility than a gift annuity. But this is a simple device for them. Usually they have fewer assets to give than really a trust requires. In our opinion, unless you're going to put at least $250,000 in a charitable trust, you should probably be looking at a gift annuity for sure, only because of the startup cost associated with charitable trusts. Then many donors would like to have a higher income than they're currently receiving from their other fixed investments. And of course, for the last number of years, we've been in a very low interest environment. And so the typical gift annuitant is someone that's sitting on some bank or credit union deposits, earning less than 1%, maybe a little bit more than 1%. They don't want to touch the principal because they don't want to run out of money. And but they sure like a little more income to keep up with the increasing cost of living. They are good candidates for a gift annuity. And then sometimes a donor wants to set up some kind of a fixed income device for some other person, maybe to help their mother-in-law with some skilled care expenses, and maybe a sister, or even a valued employee. We've seen people set up gift annuities for their housekeeper. So a lot of other uses for a gift annuity other than just for oneself. The average CGA donor looks like this. The average age of someone setting up a gift annuity is 79. So this is not for the 40-year-olds, obviously. 50% of gift annuitants are females and 43% are males. 70% of gift annuities are for one life only, and 30% then would be for 2 lives. And those lives can be concurrent and consecutive as far as their income stream, but there is a maximum of 2 lives by law for a gift annuity. If we want to benefit more than 2 people out of this contract, then we'd have to shift to a pooled income fund or a charitable remainder trust. Then these statistics come from the American Council on Gift Annuities. About 88% of people start their gift annuity income immediately. The balance would defer it. Okay, so what kind of assets are we going to use to fund a CGA? Well, a very common asset happens to be cash, because as I said, many older adults are sitting on large cash deposits. They don't trust the investment market and so on, so they're sitting on fixed income devices such as savings accounts, money market accounts, maybe a certificate of deposit. Therefore, they can take those funds and use that cash to fund a charitable gift annuity. Some might also be sitting on some securities, maybe some appreciated stock that their great aunt left them years ago, and they haven't sold that stock because they didn't want to pay the capital gain on the appreciation. We can fund gift annuities with securities. And we can even fund gift annuities with real estate, maybe a vacant lot or a duplex that the donor wants to turn into something that they don't have to maintain. And even other assets such as commodities. Living in the Midwest here in Iowa, we have a few folks around here that grow corn, soybeans, and you can fund a gift annuity with commodities such as grain, and even closely held stock of a private business. Most of the time we're using cash as securities, but don't close your mind to the fact that we can use other assets to fund those gift annuities. And we particularly have expertise in how to do that because of some of the experts that we partner with that can help with that. Okay, so how do we determine the annual rate of payment to your donor? Well, we don't determine that. You don't determine that. We rely on the American Council of Gift Annuities to set that rate. And they set that rate. And it's, if you follow that rate, which we highly recommend, that is the rate that they will receive for the rest of their life. The American Council determines those rates. They will change them occasionally. Right now, we're based on the table that was last approved back in November of last year, which didn't change from the prior April. The American Council meets on a regular basis to set these rates. The older you are as a gift annuitant, when you start receiving payments, of course, the larger the payments. Because the shorter your life expectancy, and we'll show you an example of that shortly. And those payments can be quarterly, semi-annually, or annually, depending on the wishes of the donor. But once you start with a particular mode, you cannot change it. Most people do quarterly. So here is an example of these gift annuity rates as of last November from the American Council on Gift Annuities. 65-year-old will receive a payout from their deposit of 4.7%. 75-year-old about 5.8%. And 85-year-old about 7.8%. And for those 90 plus, and there are more and more folks that are 90 plus, we had an inquiry the other day for 2 92-year-olds. They get a 9% payout from their deposit. That really gets their attention. And I believe that CGAs, because of these rates, are really donor-centric. If we can help a 75-year-old widow that is living on 1 or 2% interest off her bank deposits, wouldn't it be lovely if we could about triple that income for her and assure her that's going to be there for the rest of her life? I really enjoy helping folks in that situation. So, how does the American Council on Gift Annuities determine these payout rates? Well, first of all, they assume that at the death of the donor, about half of the value of what was put into the account will be left to be passed on to charity. That's part of their calculation. We assume an investment allocation of about 40% in stocks or equities, and about 55% in fixed income bonds, like a 10-year treasury bond. and then about 5% in cash, similar to a T-bill. The current blended gross yield of that type of portfolio is about 4.25%. So obviously, if we're paying out 99% to a 90-year-old and we're earning 4.25%, we're going to be dipping into principal, but that's assumed in the calculation of these rates by the ACGA. So they're also assuming a 1% investment load borne by the pool, and then there's also an allowance for additional expenses for doing the administration and actually running your CGA pool. They assume all donors are female, a year younger than actual, with the annuity 2000 projection scale AA. Those are technical terms used by actuaries to produce these payout rates. We also are assuming that the payments are made quarterly at the end of each quarter. So that's how the ACG puts out the rates. Now let's talk about the tax benefits to the donor of a charitable gift annuity. Of course, they receive a partial charitable income tax deduction when they set up the CGA. Obviously, they don't get a full deduction because they are retaining some right to those funds, the right to income for the rest of their life. The charity doesn't get to use the money until after the death of the donor. So therefore, they're only going to get a charitable deduction equal to the present value of the future remainder that's going to be going to charity based on the donor's actuarial life expectancy. But it's really cool because with the way gift annuity income is taxed, each portion of the payment is considered to be a tax-free return of principal to the donor. So that helps. And then at the donor's death, the remaining balance is paid to the charity outside of the donor's taxable estate, if they're in a taxable estate. Not many people are anymore with the high estate exemptions, and then generally about 50% should be left. Okay? The advantages and disadvantages, we're going to kind of go down as far as gift annuity. We've got the advantages. Of course, that initial income tax deduction is nice, but the real benefit is a guaranteed fixed annual payment for life. They don't have to worry about running out of money from that particular deposit. Partially tax-free income for a specific period, usually about the first 10 or 12 years. And it leaves a lasting impact in the community. After all, that's what charitable giving is all about. We want to help others at the same time that we're helping ourselves. Disadvantage of a charitable gift annuity, the main one that I focus on is the lack of flexibility. You cannot change the income coming out of the annuity. It's a fixed dollar amount. It will not change. It won't go up. It won't go down. And about all you can do as far as flexibility is to discontinue the annual payments and leave the remainder of the annuity to the nonprofit early if you don't want them to wait until you pass away. Other than that, everything is fixed and in cement. Now, okay, adjust my mic here. All right. So what a charitable gift annuity is not. It is not a commercial annuity contract issued by an insurance company. The word annuity, in my opinion, has been kind of maligned by the financial services industry, and they're considering annuities as investment vehicles. Well, the word annuity simply means a series of payments. If you look it up in the dictionary, that's what it means. Well, a charitable gift annuity does not normally involve an insurance company. It has no charitable income tax deduction because insurance companies are not nonprofit. I think we all know that. And in effect, you're naming the insurance company as the beneficiary of the residuum at the end of your life if you do a single premium immediate annuity, which is kind of similar to a charitable gift annuity. So if your donors start thinking about, well, I've got an annuity, it was issued by XYZ insurance company, that is not a charitable gift annuity. So let's just use a quick example here of Mary Jones. Mary's 75 years old, and she's now in the 22% tax bracket, according to the new tables. And she's got $20,000 that she'd like to deposit into a charitable gift annuity. And so she puts that with the nonprofit in exchange for a contract that's going to give her income for the rest of her life. Well, if she's 75, then she's going to receive about 5.8% income, which is $1,160 a year for the rest of her life, of which for the first number of years, $863 is going to be tax-free to Mary. The frosting on the cake is that when she deposited those funds with the nonprofit, it generated her income tax deduction of $9,300. That's going to be pretty significant when we start talking about the effects of the new Tax Act on charitable gift annuities. This is going to be a good thing. Then, of course, if Mary lives to her life expectancy, we expect that at the end of her life, about half of the deposit, about $20,000, should be left to then stay with the charity at that point. So Mary likes this idea because she started looking around at what else she could do with $20,000. Let's see. Well, I could put it in a 1% savings account if I could find one, and that would pay me about $200 a year. It's all taxable, so I have to pay income tax on that in my 22% bracket. So that means I could spend $156 after I pay the tax, and of course there's nothing for charity, because banks aren't charities. Or if I can tie my money up for a little while, I can, you want to change that? We're going to change mics. Testing 1, 2, testing 1, 2. I'll tie it up for a couple of years and I'll get 2%, which is $400 a year. It's all taxable, but I get to spend $312. Or I could put that $20,000 with my favorite charity and could get a payout of $1,160 a year, as we just saw, of which $863 is tax-free. Taxable portion $896. So I've got $1,094 to spend versus $150 or $300. This is not a hard decision, is it, Mary? And in fact, on the top of that, I get a one-time $9,300 charitable income tax deduction for this arrangement. Pretty good thing. So Mary has a younger sister who's 20 years younger than her. She was the caboose in the family. Her name is Susan. And she was talking to Mary about these gift annuity things, but she said, you know, I'm 55 and I'm still working. I like the idea of having a fixed income later to add to my retirement, but what can I do? So, well, let's see. Susan, you can put $20,000 in cash into a deferred charitable gift annuity. And you're going to have an income tax deduction of $11,400, even greater than your sister, even though you're much younger, because you've told us that you don't want your annuity payments to kick in until you will be 75. So you'll have this just kind of sitting there growing for about 20 years. And then that's going to kick out an income to you of about $2,100, almost $2,200 a month when you are 75 in 2038. So we can kind of put you on the same track as your sister. And of course, then at your passing, if you pass your life expectancy, there'll be about $10,000 left for your favorite nonprofit. So deferred gift annuities can actually work very well, especially for some of the younger donors. Okay, so then who would be a typical person that could benefit from a CGA? Well, we think that normally it's people 55 years of age and older. Again, this is not for the 40-year-old or the 30-year-old. Those individuals who want to give to their favorite nonprofits but are needing that security of income for retirement. They're afraid they're going to run out of money, so they might only want to give you $25 or $50 a year now instead of what they're really capable of because of the fear of running out of money. They want their income stream to be continued in the future, but don't want the investment responsibilities. They don't trust investment brokers. They're afraid of the markets, and so they want that fixed income. And those individuals are some highly appreciated but low dividend paying stocks, bonds, securities, mutual funds, or other type property that they want to convert to a higher income. They make great candidates for a CGA. Okay, so we kind of gave you the basic rudiments. Now let's talk about how do we implement a charitable gift annuity. Well, many nonprofits have found that sometimes it's not as easy as we think. Sometimes we're sorry we ever got into that business. We hear this primarily from the CEOs and the CFOs. And so here are some mistakes that we found over the years that many nonprofits who are issuing their own charitable gift annuities run into. There's a tendency that once the donor makes a deposit in the gift annuity that we have a need come up, and I think maybe we just robbed that bucket to take care of our current need, and so then it kind of denigrates the CGA pool. Sometimes they might grant a rate exception and just pay a donor more than what the ACGA rate would be. They might not have asset liability match in their investments for their investment people don't understand it. There's no risk management plan matching the risk tolerance of this pool with their other pools of money. Most don't periodically review their CGA pool. And so as a result, we call it the ostrich approach. And then we don't do anything with this pool of CGA funds for years, and all of a sudden we realize we're in trouble. And so we have a solution for that, especially if you haven't started offering gift annuities through your nonprofit. We have a way for you to avoid those mistakes. So how can you profit from, how can you offer gift annuities if you're currently not doing so, or if you're offering gift annuities and you're not registered in particular states where your donors might live, particularly New York and California? Very, very difficult to get registered with those states to offer gift annuities. So we have developed a Charitable Gift Annuity Solutions program through the Charitable Giving Resource Center that can be used by any nonprofit in the U.S., and there's no charge for using it. It's a turnkey program that can be ready to go in a matter of minutes. If you spend about 30 minutes on the phone with Elaine Appleby, she can get you up and running. It's that simple. We're dedicated to serving nonprofits of all sizes, but particularly the smaller nonprofits that really don't have the wherewithal internally to be doing the administration, investing, and have the liability on their balance sheet of the future payments to the gift annuitants. Charitable Giving Resource Center and with its strategic partners can offer you this turnkey program in accordance with the American Council on Gift Annuity standards. We will not deviate from that. So here's kind of how it works. We have the donor that passes their assets to the National Gift Annuity Foundation that we've had an arrangement with. That is a 501c3 that only does gift annuities. Then the income goes back to the donor for the rest of their life. But at the donor's death, then the National Gift Annuity Foundation provides you with the remainder interest from their foundation to your charity. So during the lifetime of the donor, that liability for those future income payments was on the balance sheet of the National Gift Annuity Foundation, not on your nonprofit's balance sheet. CFOs really like this. Who's the National Gift Annuity Foundation? Well, it was founded by Brian Klons, which he calls it the Decomai Foundation. It's doing business as the National Gift Annuity Foundation, which is a better term to understand. And it specializes in turning risky assets, vehicles, etc., apartment houses into charitable grants for nonprofits. That's why that foundation was formed, but that's the foundation we're using for our gift annuity program. It has the two life income business lines. We have the National Gift Annuity Foundation and a National Pooled Income Fund that we could be glad to talk to you about offline if you're looking at trying to do a pooled income fund, which I've kind of had a resurgence in popularity, but most nonprofits don't want to get into administering them. So we have a solution for that too. The National Gift Annuity Foundation offers gift annuities based on either donated liquid assets like cash or illiquid assets. You have a donor that wants a gift annuity that they want to fund with a apartment house, a piece of farmland, art, a used school bus, whatever it might be, we can handle that. And the National Pooled Income Fund is able to do the same thing. And the total unrestricted assets of the National Gift Annuity Foundation as of the first of the year, last year, was over $106 million. That's really important. If I'm a donor, I'm going to say, who's backing up that income stream that you're promising to send me for the rest of my life? Well, that is the unrestricted assets of the National Gift Annuity Foundation through the Decomai Foundation. Most nonprofits are not sitting on $106 million of unrestricted assets backing up their gift annuity payments. So our program works this way. We'll take minimum gift annuities at $20,000 deposits. Minimum age is 55. There's no contract. You can do one gift annuity through our organization, or you can do 100. The agreement is with the donor and National Gift Annuity Foundation with your nonprofit as the beneficiary, but we still want you to maintain that donor control and that donor relationship. The National Gift Annuity Foundation does not solicit directly from any donors. They just provide this as a service to nonprofits. You retain that relationship with your donor, which is very, very valuable. And there's no cost for doing this to either the donor or your nonprofit. And we now operate and are approved for issuing gift annuities in 49 states where your donors could live, excluding Hawaii. they wanted us to move to Hawaii, and I turned down that gig. I'm not sure why I did that, but you do have to have brick and mortar in Hawaii to offer gift annuities in the state of Hawaii. However, we can do pooled income funds in the state of Hawaii with no problem. So there we are, 49 states. They're all dark blue, and the only green one is sitting down there just near Alaska in that little Hawaii. So if you're currently issuing gift annuities and you're located in Indiana and you have a donor that's in California, we can handle that for you. So we follow the ACGA recommended rates. And regarding the investments, we use model portfolio and almost exclusively low-cost index fund investments, nothing speculative. By keeping those costs down, it helps keep the CGA pool very viable. The annual fee of total is 2%, which includes the administration of the gift annuities, which we have partnered with the Charitable Trust Administration Company, CTAC, out of Cleveland. And that's basically what they do. They have thousands of gift annuities that they administer. That's all they do. The investment management for the CGA pool that we have at the National Gift Annuity Foundation is done by one of our sister firms, the Sherpa Investment Management Company, which is a fee-only registered investment advisor with the Securities and Exchange Commission. It receives no commissions for doing any investments, all on a fee basis. So it's predictable. And then the process and coordination, providing you with illustrations, helping you with donor discussion assistance, and helping you through the application process is done right here at the Charitable Giving Resource Center. These are the CGA best practices were promulgated by the American Council on Gift Annuity. We think it's really make sure that your donor understands that this gift is irrevocable. They can't change your mind. It's not a bank deposit. Make sure that you have the contract and the disclosure statements signed by the donor, because a lot of times this is being done virtually or through the mail. We're going to follow the ACGA rates. We're not going to be bidding one charity against another and pay a higher rate for one than another. We've got these established minimum amounts for a gift annuity, and I know there's some charities that are still issuing 5,000 and 10,000 gift annuities. We've run the numbers, and it's very, very difficult to come out with your administration cost on that small of a contract. So our minimum is 20. And minimum age for an immediate annuity is 55. And we developed a gift acceptance policy that specifies what assets will be accepted. So these are the common best practices by the American Council on Gift Annuities, and we follow those to the letter. If you'd like to try it yourself, we can. We've arranged with the Stelter Company. Many of you might use them for your websites to use a charitable gift calculator. If I can make this work, let's see. If I can just click on this. If I can click on magnifyyouриmpact.com. Oh, look at there. It's thinking about it. Okay, there's our Charitable Giving Resource website. And up at the very top, it says Charitable Gift Calculator. You click on that little green box. And then this comes up. It's a gift illustrator. We want to click on the gifts that pay you income. And charitable gift annuity is on the left-hand side. And let's see, immediate payments, we click on that. Oh, this thing comes up. Oh, there's our donor, Mary. Oh, Mary, she's 75. Okay. So, and she's going to push some cash into a gift annuity. Well, let's see, 20,000. Oh, yeah. We've already told you that would produce $1,160 a year income for her, about a $9,100 charitable income tax deduction, about $10,000 left at her passing. And Mary might say, well, what happens if I put 30,000 in? Okay, you just grab this and move it over. If I can do it right. Okay, I'm up to 29,000. It immediately changes it on the right side so you can see what her deduction is, what her income is. If she says, well, what if I want to do it for my older sister who's age 79? It changes it again. It's just instant. I mean, this is not real sophisticated software, but it gives your donor an idea of what this would look like for them if you're sitting in their living room with your laptop or your iPad. It's a little small to use on your smartphone, unless you have one of those big ones. So that's a nice little tool that we have there for you for your use. Okay. Now I've got to get out of this and back to my, there we go. So let's talk about the new tax law, everybody's favorite topic today. And what we're hearing from a lot of nonprofits is the sky is falling down. No one's going to give us any money anymore because it's not deductible. Da 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 da. We're here to say the sky is not falling down. Don't panic. It's going to be okay. So, we got some new lower tax brackets, and we believe many taxpayers are going to find that their overall tax bill is going to be decreased, given the more discretionary funds with which to make contributions to your nonprofit and to help the economy and all that good stuff that the tax law was designed to do. More disposable income means more opportunities to donate to charitable organizations that they care to support. So here is just a quick example. This is the single tax filer chart, and the following slide will be a joint. And we just compared there the 2018 income brackets and the percentage of tax versus the 2017 on the right. And you can see that the 10% bracket really didn't change. But it used to be if you made over $9,300 as a single person, you went into the 15% bracket, from there up to $37,000. Now you're going to be in the 12% bracket, from $9,500 up to $38,000. So they widened the bracket a little bit, lowered the rate, did the very same thing in the 25%, the old 25% bracket. And now it's at 22. That's where our friend Mary is, that we've been giving you her example. And so you can just see the kind of the change there. You can see that the rates are down, and particularly there's that bracket let's see, is that 33% bracket was 191 to 416 is now 157 to 200. And then that next 35% bracket really got widened. So it goes up to 500,000 instead of 418,000. Then above 500,000, you're going to be in the 37% top bracket as opposed to the old 39.6. Same thing for married filing jointly. We got the similar rate structure there. So rates are down, brackets are slightly widened. That's a good thing for most people. Doesn't affect everyone that way, but most people will benefit. Okay, then here's the big deal, the standard deduction. Up to prior to this year, 70% of all taxpayers did not itemize their tax deductions on their tax return. They took the standard deduction. Well, in 2017, a single person, that was $6,350. You got to deduct $6,350 whether you paid any mortgage interest, made any charitable contributions, paid property tax, didn't make any difference. This year, that's up to $12,000, so it about doubled. And for married filing jointly, it also doubled from $12,000 last year to $24,000. So a married filing jointly couple, they're going to deduct $24,000 whether they write an interest check to a bank for a mortgage, whether they send $1 to a nonprofit, it doesn't make any difference. However, if they have deductions that exceed the $24,000, they can still deduct those by filing an itemized deduction Schedule A on their tax return. So the new tax law retains the charitable deduction. It has not gone away. It may not be usable by quite as many people, depending on how they work their tax situation. But it also does limit the mortgage interest deduction to the first $750,000 of principal value on a residence. It also got rid of mortgage interest deductions on mortgage line of credit, home equity mortgage line of credit loans. They're gone. And we're going to limit your state and local tax deductions to, and that includes your property tax, to $10,000 per person per tax return. That used to be unlimited. So those of you that live on the coast and high tax states, you're probably not too happy about this, because your state income tax and your property tax will often be more than $10,000. You're only going to be able to deduct the $10,000. That's what's called a SALT tax, S-A-L-T, state and local tax. Then medical and dental expenses, we're almost going to go out, but we're going to keep that for one more year. But you have to exceed 7.5% of your adjusted gross income before it's deducted. Casualty and theft losses are repealed going forward. And you notice there, that's from 2018 to 2025, because after 2025, this tax law sunsets, and then we go back to the 2017 rules, unless Congress extends it, does new legislation, and so on. And then the job expenses and miscellaneous deductions are always subject to a 2% floor of your adjusted gross income, beyond which you could deduct it. That is now gone. So no more deducting your tax preparation fees, your investment fees, and so on. That went bye-bye. Now, as it pertains to charitable giving, this is a little boost here. Previously, the limit for deducting in a given year your charitable contributions to a nonprofit were limited to 50% of your adjusted gross income. That has now been boosted to 60%. Now, you might say, well, most people aren't going to give half or 60% of their income to a nonprofit, but I'll show you an example where that could have quite an interesting result. So it may encourage higher income donors to increase their cash giving, because to the extent that they can get past the $24,000 joint standard deduction, the rest will be deductible to a higher limit in year one. And of course, if you exceed 60% with your cash gifts, you get to carry the rest over for another 5 years, so you use it up. That's still around. Okay, so let's go back to Mary, and she's decided, well, let me see what this new tax law. If I put $50,000 of cash into a charitable gift annuity, that gives me a $23,252 tax deduction. Whoa, that's pretty nice. And I use cash, and so it's going to give me, $2,900 a year and so on. But focus on the tax deduction there for a minute. So the year in which Mary does her charitable gift annuity, is Mary going to take the standard deduction for a single person of $12,000? I don't think so. She's going to itemize. And so as a result, we have a little chart here that says, okay, Mary's adjusted gross income is $60,000. If she doesn't do the CGA, she can take a standard deduction of $12,000. She's used to making current charitable gifts of $5,000 that she will not be able to deduct because it's less than the $12,000 standard deduction. So now her taxable income will be $48,000, and a portion of that's going to be taxed at that high marginal tax bracket of 22%. But if she puts $50,000 of capital from her bank account, not from her income, but she moves an asset from her bank account over to a CGA with your organization, her $60,000 adjusted gross income now gets to itemize a tax deduction of $23,252 for her CGA. And if she still wants to be contributing her $5,000 in her annual giving, she can now deduct that, because that combination is now $31,000. That's in excess of the $12,000 standard deduction. So she gets to deduct $31,748, and she gets to deduct $28,252, which brings her taxable income down to $31,748. Well, guess what? Now she slips into the 12% bracket. If you go back and look at the tax charts, now she's even in a lower tax bracket. This is a good thing. Planned giving is really going to help these individuals that think they can no longer deduct their charitable contributions. So I hope that gives you an idea of how planned giving can really help some of these folks that think that they've had a benefit taken away from them. So with the stock market at all-time highs, I hit another one yesterday. Funding CGAs with highly appreciated securities, pretty effective, because we can now bunch charitable deductions with CGAs in 1 year, then take the standard deduction in the next year. So you do a CGA this year with some appreciated securities or some cash, be able to deduct your annual contributions. Then next year, you just simply take the standard deduction. And we're hearing more and more of people think about setting up donor advised funds to do their charitable giving, and by bunching these deductions in 1 year, taking the standard deduction next year, and going back and forth. So this is the positive message that we want you to take to your staff, your board, and your donors, that charitable giving is still very much alive and well after the 2017 Tax Act. So Elaine, did you have some questions that have come through? Okay. We can secure your nonprofit's future through planned gift implementation. We can help you get the job done, and we help leading charities double their planned giving efforts with limited investment on their part. So now we have a chance for some questions. Elaine?
All right, we're going to have Tim help us here.
Tim, the tech guy. Okay.
Thank goodness we have Tim. So the question is, so can I give you my New York, New Jersey, California annuities as they come in, but keep the easy in-house or easy states like New Hampshire and Maine in-house?
A real simple answer, absolutely yes. So if you're currently issuing gift annuities on your own for your own nonprofit and you're comfortable with those states that you are comfortable with, fine. But if you have donors in the hard states where it's hard to get registered, very expensive, you can offload those to the Charitable Giving Resource Center, and we will do those for you at no cost. Absolutely. Love to do that for you.
All right. Next question is great overview. Can you talk about the 2012 IAR rate that I think some states are requiring charities to comply with? What effect is this having on pools, etc.? Thank you.
That has to do with some existing pools, and that's really beyond the scope of our discussion here for today. But if you can contact us offline, we'd be glad to have that discussion with you. That's a little beyond the scope of what we're trying to do here today.
Right, and our contact information is on this slide, which will be sent out with the link of the presentation when we have that. So the next question, do you have brand material to share with clients that include nonprofit's name and logo? Who to contact at the nonprofit?
Go ahead, Elaine. That's in your department.
Yeah, so we can send you some information. We're happy to have you brand that. Again, that's a conversation that we can have offline. If you'd like to give me a call or send me an email, I can walk you through the process and how we can act as your back room.
We'd like to help you with that branding if possible, because that helps you maintain that donor relationship. We'd like to be as invisible as possible, but we still have to legally be identified as the holder of the gift annuity and the promise of the payments. But we want you to maintain that relationship and enhance the relationship with those donors through this offering.
Right. So one of our locals, David Burrier, said, love the acorn image. Thanks, David. I took that when I was on vacation down in Missouri. So then we have a question. What is the maximum amount that can be placed into a CGA? Thanks, Brad.
Well, there's technically no maximum amount, but our posture through the National Gift Annuity Foundation without special approval is $250,000. We've already had several that have come to us with $500,000 and $1 million CGAs. We're willing to look at those. The answer is, will we take them? It depends. We would probably be discussing why would they be not using a charitable trust or pooled income fund instead of a CGA. That's going to be more donor specific. So the easy rule is up to $250,000, no questions asked, no problem. Above $250,000, let's talk. The answer is not necessarily no. The answer is it depends.
Okay. So we have a question from Bernie, and Bernie, I owe you a phone call. When does the National Gift Annuity Foundation send the remainder fund back to the charity? Is it when the donor dies?
Yes, yeah. At the death of the donor, that as soon as we have recognition that the donor has passed away and we've cleaned up that final payment to them or their state, it then immediately comes back to the introducing charity. National Gift Annuity Foundation does not want to sit on those funds. That's not what they're in existence for. But what you might be interested in, we were talking to a nonprofit yesterday that's doing their own charitable gift annuities in-house on a very small basis. Guess what? They were having that administered through a bank, and they realized that they've been paying out payments to a deceased donor for 4 years after her death, and her daughter was cashing the checks. Our administration says we check quarterly death records on anyone that has a gift annuity to make certain that that doesn't slip through the cracks. And so we're really serious about getting those remainder funds to your nonprofit as soon as the donor dies. And we're going to probably have to tell you that the donor died if you didn't know that.
All right, next question. When a farmer donates grain to us, he does not claim the income from the grain donated, but can still claim the production expense. Can a farmer get both tax benefits when placing the grain sales into a CGA?
It's very similar to, you're talking about doing an annual gift of grain sale of grains, and we really promote that, especially in the Midwest here. It works the very same way with the gift annuity. There would be the grain goes into a special account that then provides for the gift annuity income and avoids the tax return of the farmer because it was never considered income to him. And then he still gets all the production expenses as deductions. It works the same way as an annual gift would be. Absolutely. It's a great device, especially, I would say, for a farmer who is in his year of retirement. When a farmer retires, they sell the machinery at auction, which is all depreciated. They get to recapture all that depreciation and pay ordinary income tax on it. And then the same with their grain. Now they don't have any expenses to offset the grain sales, and they get nailed with a ton of tax on the grain sales. So that works both with a charitable gift annuity and with a CRT. We've done them several times for that. And in fact, I had a farmer in here this morning in my office that actually did that with $2 million worth of farm machinery in 2017, and he loved it.
Okay, on a 2-life annuity, do both parties need to be related parties?
No, they do not. They could be an individual and their next door neighbor. They do not have to have any kind of a genetic relationship. Often they do. Often it's sisters or cousins, but it does not have to be. They do not have to be related.
All right. Can nonprofits market to states it's not registered because of your service?
Well, absolutely, because now you can say, well, we can do gift annuities in California, we can do them in Nevada, we can do them in Oregon, we can do them in Washington State, wherever the donor lives, and so you don't have to ignore those donors for your gift annuity program, even though you might be issuing some on your own in your own state or contiguous states. That's another reason we put this together, because we found that it just doesn't pay if you're located in Ohio and you have a couple of donors in Florida and in California. Are you going to go get registered and do all the bookkeeping just to keep those regulators happy? Probably not. For 1 or 2 donors, we can help you with those particular donors. Absolutely.
All right. Bernie asked, I have many agents, advisors, planners that work with charities and ask me about CGAs. If they send the lead to your organization, is there a finder's fee, commission, etc.?
Real quick answer, absolutely no. We do not pay finder's fees. We do not share. That's conflict of interest in our opinion, and we're not a sales organization designed to provide commissions to agents. That's absolutely forbidden, and therefore we don't hear from a lot of those. But if they really do care about their client and doing the best for them, hopefully they'll ignore that issue and maintain the relationship, help the nonprofit by getting a gift annuity set up that doesn't have those egregious commissions built into them.
Okay, back to the grain donation question. Does a donor get the same tax benefit when opening a CGA?
Does the donor get the same tax benefit with grain opening a CGA as if they made a direct gift to the charity? Yes, you're simply avoiding recognition of including that as taxable income. It avoids your tax return altogether. Maybe the question is, do I get an additional deduction on top of that? The answer would be no.
I think we've answered all the questions that we've received at this time. So again, thank you for your time and all the great questions. We have recorded this program and...
Oh, there's another question.
Oh, we have another question.
Keep them coming. We have time.
So Jessica asked, what does the calculator show age 45 if minimum age... Oh, why does the calculator show the age 45 if the minimum age is 55?
Because we didn't design the calculator, we just borrow that from the folks at the Stelter Company. Our rules internally for our gift annuity program is a minimum of 55, and that's set by the National Gift Annuity Foundation. That's the only reason. And the other reason is that you can use that calculator for other things, such as a pooled income fund. There's another button that you can click for pooled income fund or even a charitable remainder trust. And that's the same gradient that they used. I'm sure that's the reason that goes down that low. In fact, we can do pooled income funds down to about age 20 now, believe it or not. That's another whole topic. That'd be another good webinar, wouldn't it, Elaine?
Yeah. So another couple of questions. Is there some kind of gift tax issue if someone funds a CGA for a neighbor?
Good question. In fact, you could have a gift tax income issue if you fund a CGA for a child or a sister or a mother. So theoretically, if you're going to put money in a CGA and they're the only income beneficiary, this other person, you effectively made a gift to them of the present value of the future income stream that they're going to be receiving, and that theoretically you would want to file a gift tax return to indicate what that would be. Of course, now under the new rules, you can gift annually to anyone $15,000 per year with no gift tax on the donor's part. But to the extent you'd make a gift larger than that, then you simply file a gift tax return and use up some of your lifetime exemption, which is now $11 million per person. So if I want to give a gift annuity to my mother-in-law who's 88, she's a very nice lady, and I want to put $250,000 into that and get myself a nice big fat about $150,000 tax deduction, I can do that. But I have made a gift to her of the present value of those future income payments, and I'd have to file a gift tax return. I'd be exempt on the first $15,000 of that deemed gift to her, and then I would use up some of my $11 million lifetime exemption, which would more than cover my meager estate. That's not a problem. I hope that answers the question. It's more technical than you probably wanted. So the answer is yes, there's a gift tax implication. The actual the result of that is usually no gift tax paid by the donor. And of course, donees never pay gift tax on gifts, period.
All right. Next question. Are you going to share these slides? I am going to turn the PowerPoint into a PDF, and we will send that out to those who register for the webinar.
Absolutely.
Next question. A donor asked me if she dies in the year her CGA is given, is there any payout to her state for that year if it is before the payout date?
Okay, let's see if I understand the question. A donor sits at the CGA on July 1st and dies August 1st before the end of the quarter, and so she didn't receive her payment. Is that it? And then would her estate receive the payment, that the partial interest payment that's due? And the answer is yes, up to the date of death. But as of the date of death, then income stops, and then the residuum goes to the nonprofit. It'd be the same with a charitable remainder trust. They work the same way.
Well, I think we have answered all the questions that we have right now. I will go ahead and wrap it up. If we happen to have a question come in the next 4 minutes, we will go ahead and answer that. But as mentioned before, we've recorded this program. It will be available on our website. That's magnifyyourimPact.com by Monday, January 29th. If you'd like to start offering CGAs to benefit your nonprofit and donor or have additional questions, I'd love to visit with you. John and I are both available for additional conversations and follow-up. Again, we'll be sending a follow-up email with contact information and the PDF and the link to the where the presentation's at on our website in order to continue the plan giving implementation conversation. We look forward to being your partner in growing your plan giving program and creating sustainability to support your organization's mission-driven work. Have a wonderful rest of your day.